Todd, what's happening, man? How you doing today?
Doing great. How are
Good,
you?
good. I'm doing fantastic. Had a little snafu with the technology, but uh, one thing about you and I, we don't quit, man. We just keep going till we get it done.
Absolutely.
So tell us who you are, Todd, what it is you do, and why we're listening to you.
Todd Caldwell, First Securities Mortgage. We are a full service mortgage banker slash broker. We have access to multiple banks and we compete against the heavy hitters in the nation. We're a small company out of Bingham Farms and we just move faster. We're a little smaller than the big companies and we'll compete that way.
Okay. Tell me, this COVID has halted business in a lot of different industries and areas. How has it affected the mortgage business and you giving people finance for homes?
It's putting the bite on a lot of people that want government loans. Some of the banks are not selling the government loans on the open market. They have to hold them, and when they hold them, they're going to make sure that they're high quality. And the ones that are working with the lower credit scores are also doing the same thing. Only people that can hold their loans are actually working right now. And the ones that we normally are go-to for the hardest deals or the weirdest, strangest deals, they're our go-to now for FHA, for example. Not all VA, but definitely almost every FHA loan goes to those two places because the most places in the nation won't do FHA loans below a 680 or a 700 credit score. Chase just announced a few days ago they will not do any loans under 700 credit score, and you must put down 20%.
I did
So
hear
most
that.
of us have access. I'm sorry, what?
So I did hear that from Chase.
Yeah. So we have multiple lenders making up their own rules, and we have other lenders following the guidelines. The problem is the pricing on low credit scores, everyone's going to pay. Everyone's paying. Chase has got that right on their website that they recommend you pay points to get the rate down. It's right on their website today. I looked at it, and they're always, and they're it's a bait and switch. Only a few people are getting the greatest rates in the nation, but they're still really good. Don't get me wrong. They're really good. But it's going to be a little more expensive for the people with the lower credit scores. That's what's affecting us the most. We are afraid that so many banks are going to go under. We are telling all our friends and family, do not take the forbearance the government's offering for their loans unless you're desperate, because everyone that does that, it's another black mark in our industry, another person. And we don't even know right now if the guidelines will let somebody who did the forbearance refinance without 12 consecutive months. Right now, the guidelines state if you don't pay your mortgage payment for 12 months in a row, you do not get a new mortgage, refinance, or a new home. Nobody knows what the rules are going to do. So we're recommending to everyone, unless you're desperate, if you're making money and you're making as much or almost as last time, cut back on something else, because if you go into forbearance, it's going to harm the entire industry. And well, we're afraid. Our industry is actually terrified what's going to happen next. And if the housing industry goes down, we're all going. That's one thing kept us out of recession a few years ago, is the housing industry, all the money, all the refinancing. That's well documented by the economists.
Okay. Well, definitely want to encourage people to stay positive, to stay working, to stay making the money and
Yes.
saving money, however it is that they do it. I know we got a lot of free time on our hands now. People are working from home. COVID, we got to stay home, stay safe. And so I know people are sitting at home, laying on the couch or in the kitchen cooking, saying to themselves, you know what, I want to buy a house. So I thought to do this video because, okay, you got to get the ideal first, but there's some plans and preparation that you need to do before you actually go out and purchase that home.
Absolutely. And we've taken more calls on that than anything else. We're telling people, oh, you're pre-qualified, but you're not gonna be able to see a house anytime soon. And I'm glad I'm getting calls in which people can't buy a house for 6 months or 7 months. Those are people we want to work with. So if they were even thinking about it, they should talk to somebody like us, because we will prep them for several months down the road. You don't want to do something now which is going to hurt your chances when you go to buy a house. And anytime's a good time to have your credit looked at, have an expert give you an opinion and tell you, well, if you do this, you're probably going to get a mortgage. If you don't do that, you probably won't get one. Or how do I get the best mortgage? How do I get what's advertised on television, which is a lot of bait and switch out there? How do I get that? Well, we can show you.
Right. So, me, I find the house. I'm the real estate guy. You get them the money to purchase the house. I get a lot of clients that call me and say, well, Jabari, I want you to sell me a house. And I say, well, are you paying cash or have you been pre-approved? And they say, well, what's that? I say, well, you got to holler at my guy Todd or someone like him to get pre-approved, because we can't first go shopping for a home if you're not ready, willing, and able and have the things that you need to purchase that home. So tell us a little bit about the pre-approval process. How does that look?
It's basically pretty easy on the outset. All you need is stable income, decent credit, and money. I mean, there are some down payment assistance programs. Some work for some people, some don't work for other people. That's just the way it always is. The down payment assistance, when they really work, they really work. But there's some hidden stuff in those in which you have the money. You don't want to get the extra money because you have to pay it back, and not everyone understands that. But some of them are good. Some are very good programs. We have access to some ourselves, but you have to pick and choose which program to put with somebody, the best interest. But so all you have to do is have those three things. If you have money for down payment, the seller can pay your closing costs, but there's no guarantee it's going to happen. But I see people every day getting concessions, which is the word for when the seller pays some of your costs. Seller can't pay your down payment.
Okay.
So those are three things we do.
So let's talk about three things, right? EMD, earnest money deposit. Let's talk about concessions, okay. And then let's talk about the down payment. Let's talk about those economic components that affects buyers or sometimes prevents buyers from getting to the closing table. Just so people understand the differences, okay. And how they apply to
the earnest money deposit is very simple. Oops, sorry. Now on you. What were you saying?
No, you got it. Go ahead.
Okay. The earnest money deposit is what everyone, of course, gives a realtor to show that they're serious, and shows the other realtor involved that you are serious. It's a nominal amount, $500 to $5,000. It's completely arbitrary. And a lot of people choose $1,000 when you're under $200,000. It just depends on what kind of mood you're in, and that needs to come out of your bank account. It needs to come from, has to be your money. And there are some exceptions with gifts, but the problem we run across is sometimes people take money out of their mattress, and we can't use that.
What
the
is
guidelines clearly
money?
State there's a percentage. Mattress money is kind of like my grandma, except it was in a tin can. He had several tin cans, one for school money, one for back to school clothes for my mom, and they still have those cans on their shelf. It's money that is not in a bank account. If you went out and sold a kidney or a jet ski, you didn't put it in your bank account, that's mattress money, just sitting in your mattress, the old time adage of it sitting in your mattress. And that is cash money that we can't track. So we don't like that. That is bad for my industry, because if you have a lot of cash money you're trying to dump in the bank, the banking industry doesn't know where it came from. They don't know if I'm giving you the money, you're giving them the money, the other agent's giving them the money, someone else is giving them the money, and they have no intention of living there. It's called occupancy fraud. And that's the largest fraud we have today, is occupancy fraud. They crack down on almost everything. So that's why you need earnest money. You don't want to put the money. You want to have money in your bank account at least 60 days before you start looking. And we can walk buyers through this. If they're not sure what that means, the payroll is good. Direct deposit's good. Paycheck deposit is good. Going to the party store and cashing your paycheck and put in the bank account, not so good, right? And some people hate banks, and I understand that. I mean, I feel that way a lot of days, but that's just part of it. Concessions are what you negotiate with a seller. If you need $8,000 to close on your house, $5,000 is the down payment, maybe closer to $10,000. $5,000 is costs and taxes and escrows. That's a whole 20-minute conversation. But that money the seller can agree to give you at the closing. It's a paper push. That's all it is. just a push of paper. Instead of them taking home an extra $3,000 or $5,000, they're allowing it to be credited towards you to help pay your costs. VA has slightly different rules, but similar. VA actually allows the seller to pay a credit card off, but we don't, the buyer's credit card, but we don't see that in this market. That's a little too far off topic. And it's also a seller's market right now. The sellers are in control. If this was 10 years ago or more, this would be a buyer's market, which means the buyer has more options than the seller does to sell. Right now, the seller has many more options than the buyer. So some people find themselves shut out of the housing market because they have to ask the seller for too much money. There could be 5 to 10 people waiting in line for one house, and then other homes people overlook inadvertently. It could be how they're marketed. So basically, you have an earnest money deposit. You negotiate the seller's concessions if you need them. And how do you know you need seller concessions? You talk to someone like me. We run with me and Jabari working together. We run the numbers, and I figure out, okay, it's going to cost $10,300 to get into this house, all inclusive. Then you need to ask the seller for $4,300 if you only have, 5 or 6,000. And but if you have 10,000, we tell you not to ask for it. Now, if you're a trusty neighborhood realtor like Jabari, will talk to the other realtor, and hopefully they'll tell them what you can get away with. But some of them are more tight-lipped than others. Like in any industry, people get along, people don't. So sometimes they'll tell you something. So, and then the seller's market is just you have to be wary of.
Yeah. And you touched upon something, Todd, that I think is very critical: relationships, right? People do business with people they like, know, and trust. So our business, you're in the mortgage industry, I'm in the real estate industry. We refer clients and do business with people that we know that can get it done. But the relationships are key. We're dealing with people's personal information, buying a home, getting a mortgage. These are some of the most complex and some of the largest purchases that people make. So I always suggest to clients that make sure you're dealing with someone who you have developed a rapport with and you feel comfortable, because you're letting them in your dirty laundry drawer. You're letting them in looking places you don't let people look, because we're talking about your personal financial business. And it's important because if we're going to basically represent you, you got to tell us the truth. You got to let us be aware of everything that you have going on within a certain reason, so that we can guide you through the process. We're like your lawyer, right? So if you plan to get a favorable ruling, you got to tell us the things that we need to know so we can properly represent you.
Yep.
Yeah, so that's one of the.
Couldn't agree anymore. I have people every day. Oops, sorry. I have people every day who, they don't understand how complicated the process is, and it's not as. If you have the 3 things, it's not that complicated, but it is complicated, especially when this happens, the COVID, and all of a sudden the rules that I knew today don't even apply today. And this bank over to the left is telling us that they only do 700 credit scores. And this is why Fannie and Freddie were created, is to make sure there was one overall set of underwriting guidelines for the nation. Savings and loans was what originally Freddie was, and Fannie Mae back in the 30s for convention or for regular banks. And we have a stable underwriting market. The rules are the same all across the nation with some very few nuances, but the nuances are out of control. This is what we fear if the Fannie and Freddie went away. You hear Congress talk about that sometimes. It's exactly what we fear, because if we're going to one bank, or we go to JP Morgan Financial, right? And they'll have a set of underwriting guidelines. So if Fannie and Freddie ever go away, that's what we have to do. We're gonna have to go to this bank, and then that bank, and then that bank, and everyone has different rules. And that's a problem for our industry. The stability of the industry relies on having a coherent set of underwriting guidelines with very few, we call them overlays, where banks make up their own rules. And to make it, some banks don't have an appetite for riskier loans or, lower credit scores. So what they say is, we're not doing those lower credit scores, like what's happening now. But it just happens. Sorry, tangent, keep going.
So after that client is pre-approved, right? They come to somebody like you. You not only run their credit, verify their financials, but you give them options, right? They might
If we
qualify
can, yeah.
for, yeah, they may qualify for more than one loan product. And one of the loan products
Yeah.
that we like sometimes allows them to be able to buy a house that needs work, right? So can you speak to
Those
that
are
a little bit?
renovation loans. Yep, those are renovation loans. There are two by FHA, and there's one by Fannie Mae. Without getting into lots of details, they can actually help you buy a house. You buy a house, there's slim pickings out there some days. So if you buy a house that is at $100,000, but there's a lot of equity in it, and you need to get $40,000 to renovate it, your mortgage is $140,000. You put down 3.5 or 5% minimum. There's only two options there, depending on the type. And you're of the 140, that's your mortgage. Now it's a little more complicated than that, but I'm the VA expert at my office. Excuse me. I'm the FHA and VA expert, which also puts me as the renovation expert in my office. So we know how to do all those loans. And there's always some weird thing out there, by the way. But those standard Fannie Mae or FHA construction or renovation loans, backed with a code of ethics and lots of rules to protect the consumer, those are the only three out there. Two from FHA and one from Fannie Mae. The rest are individual banks creating their own little programs, their construction programs, lots of rules, more than 5% down, I can guarantee that. And they're not backed with the guidelines that Fannie and Freddie and HUD and VA put out. They're backed by whatever the bank wants to do. It's their money. They can't sell that. It's their money. So it's not very difficult, but you need a contractor for most of this. Or even though if you look online, if you actually look at the actual name of the loan and you read about it, it says you can do it yourself. Nobody's letting you do it yourself. No one's trusting you with $30, $40, or $100, $200,000 for renovation. So you just got to be careful of that. I mean, a lot of people are do-it-yourselfers, and they have a contracting license. That's our biggest thing we ever hear is people want to do their own renovation. No, we're not trusting you. At least with the contractor, we vet them, we grab their licenses, we make sure they're a real company. We might even ask for statements. Depends, but they have to be licensed and insured, minimum, and have a work history we can work with. They're Joe Schmo off the street who's never done one job. Yeah, they're not going to be approved. But every contractor is approved. So there's three of those that are available.
So those renovation loans is another tool to add to the tool belt, right? As me as a realtor, if I'm going out with a client, if they're only approved for FHA, then I know the condition of the houses that we look at have to be in a certain condition or have very little disrepair. Otherwise, it won't qualify for FHA.
Right. FHA there's a peeling paint. There's windows if you pull them up, they can't slam shut. FHA, as the last 10 years, has disbanded a lot of their rules. They got rid of the 5 inspections, and then they had what's called a V card, and then they got rid of the V card. They had a checklist. They got rid of the checklist. Now a lot of it, there's still a lot of misconception. If you go read the guidelines, peeling paint is still on there, but there's some others that producers hit us for that are not. But it's the nature of the business. But yeah, the FHA homes, they do appraise the exact same value as conventional loans. There's just a little health and safety component. And that's also a misconception in our industry. Pick up the phone, call any appraiser and ask them if an FHA, VA, is different than a conventional loan for value, and they'll tell you absolutely not. They derive the value the same way. But there's still some people from years ago when things were a little different who don't understand that's the way it is now.
So as a seller, right? A seller gets a bunch of offers for a property. Typically, they're going to put the highest offers first. They're going to look at price, and then they're going to look at terms.
Yes.
So a person paying cash, or a person qualifying for a conventional mortgage, and then somebody at the kind of like the lower tier qualifying for FHA, the seller is going to go with the conventional loan more so than FHA because in most cases, because
they tend to,
too many ways that conventional or that FHA could fall apart at the end.
Yeah, nationally, I just read this last year. Nationally, 4% of all loans fall through. That's it. So if 96% of the loans don't fall through, I'm not sure what everyone's, that shouldn't even be a factor personally anymore. They should just look at the dollars, the dollars. That's it. And the terms. I have a personal feeling about terms. They should never be on a PA. We've had that discussion before. I think they should be blank. There should be a number, and no one should even know the spelling or the pronunciation of your name. But that's just me.
Right.
But yeah, you're right. In this market, conventional loans with less concessions or no concessions will be the number one priority. So what we do is we see some people with conventional loans try and offer less. And that's why conventional loans fail sometimes, and cash fails too. Because sometimes you get a cash buyer and they don't take our loan. Then 3 weeks later, they call us up and say they want us back because the cash buyer got real picky, right? I mean, real picky.
Yeah.
I want that painted. It's like, no, it's not against any rules. You're not going to paint that for you. I can go here and get paid. I mean, sometimes the FHA buyers are paying more or offering more. They'll go there. But every case is individual. Every seller's got their own thing. Every realtor has their own opinion. We can just do what we can do with what we have.
Okay. Tell me this, Todd, with lower loan amounts. A lot of people think that if they're coming in to get a $30,000 loan compared to getting a $300,000 loan, that the $30,000 loan would be simpler to do and easier to get closed. Can you speak to that a little bit?
Technically, the banks cannot turn down a $30,000 loan, but we see people do it all the time. They don't want to work on them. That's one option. That's one thing going wrong. The other thing is the professional investors. If I have $50,000 sitting in a bank or the Wall Street or in the stock market, you've seen what the stock market has done lately, and I can get paid a lot more money renting out that property as a professional investor, which I was, but I could get theoretically more money. So if I put 30,000 into a house, up to 20,000 more to renovate it, I'm going to flip it and sell it, or I'm going to rent it out. And for $50,000, if I can get $700, $800, $900 free and clear every month, that's a great investment. You put a $50,000 in a bank or Wall Street right now, especially today, you're not getting $800 a month cash.
That's true. That's true.
So the investors below 60,000. I think the investors, and I tell every buyer this, it's amazing how many buyers go buy a $70,000, $80,000 house and want 30, 40. And the difference between a $40,000 house and an $80,000 house is about $200 a month. That's it. And you're looking at $80,000 house being $700, $40,000 house maybe being $500. There's an inverse relationship with the taxes. So the lower you go, the bang for the buck you're getting. You could have taxes on some of these lower homes that are more tax and insurance that are more than the mortgage payment. You have a $300 mortgage payment and a $500 tax insurance bill.
Absolutely. Let's talk about people who've never gotten a loan before. I go to these seminars, I talk to bankers all the time like yourself. It's somewhat intimidating to apply for a mortgage. I mean, you all asking so much stuff. You're going through my bank accounts line by line. What happened here? What happened there? You want to know who all lives in my household. So many questions that are asking, and to some people is very, very intimidating. So how do you ease that with people or make that a little bit more comfortable with them?
It's harder when I'm not introduced to them. When you introduce me to somebody, there's a certain level of trust that you automatically get. And you're right, we look at your bank statements. We look for things like recurring $400 payments to GMAC, and that's not in your credit report. We look for that. We don't care how much you spend at McDonald's. We don't care about any of that. What they do look for is undisclosed debt. So you're right, we make jokes about it, of course, but we look at that for recurring costs that could indicate that you're hiding a debt, like you've agreed to pay your son's car payment. Well, that can be held against you. So we have to do other things. And that's an impediment to your thing. But we ask, it's mainly trust. Like you said like 5 minutes ago, it's trust. If I get introduced, it's trust. Maybe it's a 3 phone call thing. I could call them back the next day to prove that I'm actually up. That's why people that work out of call centers, they don't get as much trust. And I've had people call me out of the blue and they don't trust you as much. And they won't tell you as much. And then you get 2 weeks before closing, you found out they had a foreclosure in Idaho 5 years ago because they left the house 9 years ago, but it never foreclosed on for 4 years. And then you realize, oh, you're within 7 years of a foreclosure. We can get you this mortgage, but not the one you're in. So if people don't tell us things about themselves, we don't understand. So it's about trust. It's all about trust. The good thing about this, people like me, we are bonded, we are licensed, we have to pass tests and exams every year. Just as a side note, people that work at a bank don't. They get put their name on a piece of paper and they stay, and the feds will give them a number that says they can originate mortgages with no training. Only brokers and hybrid brokers like me have any training at all that meets an industry standard. Everyone else just assumes that FDIC insured banks police their people. They don't. Ask your teller next time. What are the 3 things you have to do after a bankruptcy to get an FHA mortgage? They can't answer it. I can. They cannot. You'll probably irritate them if you do that, though. So I probably shouldn't do that.
So answer that question, Todd. What are the 3 things you need to do after bankruptcy?
For FHA, it's 2 years. It is reestablished credit. Get an immediate credit card. You can pay it off every month or 2. And don't go late in anything you currently have that was out of the bankruptcy. If you left the car out of the bankruptcy, don't go late in that again. If you have a bankruptcy, you will live on the bankruptcy card for 10 years. That's what the credit bureaus tell us. It's 10 years on this card. You have foreclosure, now you have that card working against you. If everyone has ever had an older brother or sister and you went up and hit them, even if you run behind mom, they'll get you and they hit you twice later on or twice as hard. So that's what the bankruptcy does. It whacks you. You have 1 late or your credit balances are more than they'd like, you get double hit for negative points. Mm-hmm. So those are things you got to wait to. Now, conventional is 4 years, by the way.
Okay.
But FHA is 2, VA is 2, and rural development is 3. But in other words, there's a waiting period. It's all you have to know.
What's the time period after a foreclosure, Todd?
At 7 years for conventional with, I'll come back to that in a second. FHA 3, VA 2, rural development 3. But conventional is kind of cool. Fannie Mae recognized a few years ago that the people that are foreclosed on often have bankruptcies, and it's unfair to hit them that hard. So Fannie Mae states that if you have a bankruptcy, then and your lawyer puts it into bankruptcy, your date is not 7 years from the foreclosure date. That foreclosure could take 2 or 3 years to foreclose in some states. Florida is a judicial decree state. That's a good 1 to 2 years minimum before it forecloses properly. Michigan, where an advertisement or judicial decree, someone just advertised in the paper 4 to 6 times. I can't remember where Michigan is anymore. And then the legal news, and they can take your house without having to go to court. So FHA or conventional says 4 years. Fannie Mae does 4 years. So if you had a bankruptcy and just came out last month, but you had a house in there, technically they don't care if it ever foreclosed. Some of the banks will care, but technically they should not care. So if they foreclosed on 3 years later, now you're only 1 year out of foreclosure, your lawyer, who did a great job by throwing that in the bankruptcy, helps. Now, if you had a foreclosure 5 years ago and a bankruptcy 4 years ago, and you have a smart attorney, if they decide to ask you the right questions, if they list the house debt as part of your bankruptcy, that counts for the 4-year rule. So even though it was 5 years ago and before the bankruptcy, the attorney put it in your bankruptcy papers. By the way, I don't ever ask a borrower for bankruptcy papers. I can access that from a system called Pacer. And they gave me an account, and I can get anyone's bankruptcy papers for like $3. So you go talk to your attorney, they want 50 to 100 for a copy of your bankruptcy papers. So one of the services we offer for securities is we have an account, and we don't mind spending $3 to $4 to get your bankruptcy papers. We'll get them for you. I have clients calling me a couple years later going, "Do you still have a copy of them? If I don't, I can get them again." It's all in the federal documentation. In fact, it's better that we get them, because the ones we get from the individuals are crumpled and out of order. But the ones we get from the feds have a numbering sequence at the bottom that mimics what a county recorder would do for your deed and your mortgage. So it's better than what a consumer can give me. And it's more complete. It's 100% complete.
I was, you just mentioned Payshare. I was talking to a client a couple of days ago about these third-party data furnishers, right?
Yeah.
So everybody knows
Yeah.
about Experian, TransUnion, and Equifax, but there's so many other third-party data furnishers, at least like 2 to 3 dozen, that are providing information to creditors and lenders alike for a fee that they've just compiled and you know, collected over a period of time. So there's so much information about us out here that it's hard to hide anything nowadays.
Well, some people think that they can hide judgments. Judgments no longer appear in the credit report as of July 30th, 2018. Judgments were removed from all credit reports unless you can verify 3 pieces of information. And the judgments never have all 3 of those that they're requiring. So we still have people that are hiding, judgments, and those databases you're talking about. Every mortgage is ran through those databases. First American had a database like that. They sold it. They created another one. I'm probably going to sell that someday too. And then create another one and keep getting the money rolling in. But there's these databases. They will find your foreclosure in Idaho. They will find it. And they know it's out there. So that's why it's important for people not to lie to us, not to be scared. Just tell us what it is. The worst thing I can tell you is no, and give you my expert opinion. But some people are still scared. They don't want to tell us everything. It's like, just tell me. I don't work for an FDIC bank. I'm not going to take notes on every little thing. And the rules are out there for a reason. We're not gonna break the rules because my licensing is way too important to my family. But we know what's appropriate and what's not appropriate, and how you can get around some of the rules and still get a mortgage without fraud. Because our biggest thing is fraud. We do not want to do any fraud. We don't want the consumers engaging in it, because that's a great way to lose your livelihood.
Talk about the difference between applying for a mortgage when you are a W-2 wage earner compared to being self-employed.
W-2 is super easy, right? We use your W-2s as a looking backwards tool, and tax returns if required. So looking backwards tool just to prove you made what you made, because what you made before will indicate what you're going to make in the future. If you want from a $12 an hour job to an $80,000 job without any schooling, that could be a problem,
You're lucky.
Yeah, you're darn lucky. Yeah, I know. But a W-2 person, we break down your current overtime, your current bonus, your current year to date. And if you don't work the 40 hours that you claim you do because your boss loves you and you go out fishing every 3rd Friday, then you're not going to get the 40 hours a week. So it's all broken down. It's not W-2, here's my adjusted gross income. I make this kind of money. No. Everything is broken. If you had dividends, if you have investments and your dividends didn't come in as much this year as last year, you can't use that much. So there are certain rules against that. And 1099 employees, they are self-employed, even though you talk to a lot of people say, well, I get a 1099, I'm not self-employed. In the rules of the IRS, in the mortgage industry, you are self-employed. And not everyone does it perfect. So there's some leniency on that. If you're self-employed, you should get an LLC with the state, even if it's a one-man LLC, it doesn't have to be a partnership. You could do a one-man LLC with the state of Michigan, then use that and get an EIN, federal ID number, and then turn around and use those 2 documents and get a bank account. So what a lot of 1099 employees don't do is they don't pay their company and then pay themselves. My wife is good about this as being self-employed. She has a 1099 income. Every month, she gets 1 pay stub once a month. She takes 30% of that and puts it all in her business bank account, and then writes a check for 70% for our household income. And then we're not stuck on taxes every year. But And then if there's any issues with our taxes or with our accounting, all our business expenses come out of the business account. It's called cash accounting, cash accrual. So we actually add up all her expenses, make sure they're real expenses. Yeah, Staples, Home Depot, oh, new printer. And then we just subtract it off and put it on our tax returns. But 1099 employees, it's more important they file their taxes for 2 years as 1099. If they don't file their taxes and they don't put the same exact name of the company in there, then sometimes you don't have 2-year history. I've seen people change the name of the company and it looks like something completely different. The underwriters won't accept it. So it's really important they have 2 years of under the belt. It could be 1 year of tax returns, but you could have, or 1.5 years of tax returns, but you're 2 years in business and there's a way for that too. They'll look at your most recent tax returns as stable and the half year before that as unstable, and they'll average you and they won't use your year to date, because unless you pay $5,000 to $10,000 to a CPA, they're not going to give you an audited profit and loss. So that's hard. It's a lot of money to spend just to get a home. But it is out there. You could do that. FHA allows audited profit and losses. So if you have a great year and you had a bad year last year and your year to date's higher, if you pay a CPA, you can do it. So 1099 is not that hard. Just need your tax returns. Every other rule is exactly like every other rule for you, except how we calculate income.
Right. I know, as being a self-employed individual for a while, I've had to go out and pick up a W-2 job just to make my life easier, because
Some people do.
Just being, 100% self-employed makes it challenging when you're looking to borrow. The lending industry, they want to see regularity. They want to see consistent income, right?
Yes.
Every 2 weeks, every week, monthly, however it is, but they don't want to see the ebbs and flows of self-employment.
And that's okay though. A little ebb and flow is fine. What they don't want is no money. June, $200,000 in your bank account. That doesn't work.
That doesn't look right.
No. And when this whole COVID thing actually settles down, there's some very cool bank statement programs that are going to come back. Actually, I think I still have one lender doing it. But the COVID-19 pandemic actually drove most of these people out of the market that do, I call, they're the new subprime or the new alternative loans, where if you got great credit or decent credit, but 20-some% down, you're going to get, and you show your business bank statements for 1 to 2 years, you're going to get a mortgage. But most of them have been driven out, and they were like 10, 20% down, those programs. Now they're 40 to 50% down, and they'll still do those programs temporarily. It'll rebound. We'll see those people back in the market, but scarcity of money out there for mortgages, even though you think the money's unlimited and the banks are trading money with themselves almost at a zero rate, there's other factors affecting the mortgage market. It has nothing to do with liquidity.
VA loans, you do?
Yep.
Do you get into the reverse mortgages at all?
We do. We have access to the reverse mortgages. To me, they're the last resort. There are some people who need it, and there's others that do not. And a lot of people were taken advantage of several years ago. So I have access to reverse mortgages. They aren't as lucrative for a lot of mortgage people, so a lot of people pull back on them. I've always been able to do them, do 1 or 2 a year. But when I first talk to somebody, I tell them it is the mortgage of last resort, because it's an equity stripping product and people have been taken advantage of. Minorities in particular, heavily. It's well documented. Google it, you'll find out that people were taking advantage of, a whole lot of people.
Mm-hmm. Yeah, and I think one of the reasons why I wanted to do this video with you and kind of do something recurring is because there's so much miseducation, so many areas that people are taking advantage of financially because they don't know anyone, they're not familiar, they're not walking in being introduced to someone that they like, know, and trust. So it becomes a real big issue, right? People are taking advantage of, and I know in real estate, if something happens to somebody with a house or a mortgage, they might never buy a house again just because of that one experience that happened 25 years ago. So it's important that we really educate our clients. And one thing I can say about you, Todd, is that every client I've sent you has always came back to me and told me how well you communicated with them and how informed they were during the process and even after, once they closed their loan.
Did they tell you I talk too fast?
No, they did not say that.
Most of them do.
And I think one of the reasons why I like referring clients to you is because you get it done.
Yeah.
We are in an industry where we don't get paid until deals close. So
Right.
we need to work together to make sure that, one, we have deals, and two, they actually get closed, and the people get funded, and everybody's has what they want in the end. So that's very important.
Yeah. It's a very nice ending when that happens.
Yeah. So I want to, get to where we're wrapping it up, Todd. I appreciate your time. Is there anything that you can say to the people? You can get your contact information out.
Find me on Facebook. My phone number is 734-788-6607, 734-788-6607. I'm in Facebook too. I'm on Facebook. I think it's a picture of my border collie instead of my fuzzy face. I have the border collie on there, but they can contact you. They can contact me. They can do Messenger through Facebook. They can call my cell phone. My work business phone actually forwards to my cell phone. I turn it off by 9 o'clock to 10 o'clock every night. And it doesn't wake up again until 8 o'clock in the morning. So up until those hours, I'm free. And I'll talk to people. If I can't talk, I'm over 30. Leave a voicemail. I'll call you back.
Okay. So I want to thank everybody who's going to watch the video. We are experts at what we do. We love to see people get what they want. When you get those keys to the new house, or pull up to that family, have that first barbecue or that first Christmas in that new house, that's the real value in it for myself and Todd. So we want to make sure everybody realizes their dream of home ownership. We probably will do something like this on a routine basis, maybe more topic specific, and definitely stay in touch and make sure people stay informed and engaged. So appreciate you, Todd.
Thank you.
Talk to you soon, man.
Talk to you soon.
Till next time, we out.